Right, folks, well, welcome to today's video, and thanks for watching. Before you do anything else, and before I discuss what I've just showed you prior to this, please go to the buttons on this channel, and you'll see over here, if you go to the main channel, ArcisFX, and also next to this video that you're watching, you'll see a subscribe button, and you'll also see the opportunity to click on the bell, which will subscribe you and notify you when there are video uploads so you don't miss anything, and it helps me get my channel out there a little faster. So, having said all of that, let's have a look at what's been going on. Now, you saw the video before. I just had this little intro, and you'll have seen that there were some very dramatic moves in the market, and you'll also have seen that I lost a bit of money on the challenge account, around about 20%, which is very disappointing, but it could have been far worse. Now, that's quite a highly leveraged account. I didn't lose any of that money on my main trading account, but on the challenge account, I lost a fair whack, and you have seen, I think it was a few $1,000s, a couple of $1,000s, so you'll have seen that on the video intro, and we've seen some very dramatic moves in the market because of, well, geopolitical events, and because of also just market extremities that we've reached at the moment. You can see on this chart, for example, the Nasdaq is at the yearly lows and lower. In fact, on Friday we just broke beneath the June low, and we've seen the dollar index reaching dramatic heights. We've seen those huge moves on the pound, dropping and gapping down enormously last week, and just general chaos in the markets. We've got energy problems going on. We've got inflation. We've got extreme interest rates in various countries, inflation all over the show, as I said, and it's all very dramatic. So how do we deal with this? Well, this video is just about how to deal with the market and what I'm going to do, just to give you some pointers. Now, I've got some things on the chart here, and again, as always, it's Sunday afternoon, so the markets aren't open, except for Bitcoin, which will be open, but the markets will be open in a few hours' time, and this is my strategy. Now, what I've got here is just day charts, and I've just got six instruments, sorry. I've got the euro against the US dollar, the pound against the dollar, the US dollar Japanese yen, I've got the euro yen, I've got gold, and I've got Nasdaq. So just six instruments, and I'm going to be focusing on these six instruments going into the next weeks and possibly even months towards the end of this year, and maybe even into next year. I'm going to keep trading super simple. I'm not going to be holding positions because of potential gaps that we saw last weekend, and because of potential really bad news coming out of the Eastern European area. And we have no idea what's going to happen there. There could be some fairly dramatic events unfolding. Let's hope not, but we just don't know. And that pertains to, obviously, the Ukraine situation, and it pertains to energy supplies, and just absolute chaos going on in that part of the world. And we don't want to be a part of that when we're trading in the markets. At least we want to be very careful. Now, on these day charts, I've got very simple day charts here. I've got a red line, this red squiggly line on each day chart, and that is the 20-day moving average. I'm going to give you a very simple idea of how I trade this, and I'm not obviously going to be able to give you very much detail here, but I'll try to give you some, at least, so that you can see how I trade this risk off, more of an intraday swing trading, intraday type of strategy, rather than trying to pick tops and bottoms and predict long-term swings. So let me just try to simplify it, as I said, as much as possible. So really how it works is when we're below the 20-day moving average, we want to be looking for short positions. When we're above the 20-day moving average, we want to be looking for long positions. It's as simple as that. And that's the way I'm going to be trading going into, as I said, the next few weeks, months, and probably even into next year. It's actually not a bad idea to trade like that overall, if you're not experienced or skilled at picking levels. It's much easier to just pick a direction and trade with that direction. And in fact, if you'd been doing that over the last period, if you're not as experienced as some other traders, you would have done a far lot better than if you've been trying to pick tops or bottoms, particularly if you were trying to pick bottoms in the pound like I was. And even if you've been trading for 20 years, picking bottoms and tops in these sorts of markets can be incredibly risky and very, very difficult. So basic direction going into next week, it's as simple as this. We're going to be looking for short positions on the euro until we close on a daily basis above this 20-period moving average. So let's just zoom into that chart very quickly. So this is the euro against the US dollar. As long as we're below this 20-period moving average, we'll be looking for short positions. And you can see by and large, for most of the time, going back really into, how far do you want to go back? Into 2020, early 2021, we've been below that moving average for most of the time. And the same pertains to the pound. We'll be looking to trade short. You can put other levels on your day charts. I'm not going to go into details about this, but if you want to do, you can draw a trend line, or you can draw some horizontal lines. If you want to use some other indicators, you can, but I would keep it as simple as possible. So I've just got a little trend line in here, but I could put in some horizontal lines. And so, for example, there's an obvious one there, and there's an obvious one there, and over there, and over there, and over there, that sort of thing. And you can use those in conjunction with your moving average to determine direction and potential turning points. Now, I'll get to the turning points in a minute, but we're just talking about direction for the moment. Now, if I can just close this chart down. So dollar yen, we'll be looking for long positions. Dollar yen's at incredibly overbought levels, and it's always tempting to say, well, this chart's so overbought, I don't really want to be buying. But remember, we'll be trading on this type of system, intraday swing trades. When I say intraday, perhaps maybe within 1 day or a day or two or three, trying not to hold positions for too long, looking for smallish profits of 100 pips or less, and keeping very tight stop losses. So we're long on the dollar yen overall still, but we are heading down and sort of running out of a bit of gas. And I guess if you look at the RSI and the stochastic, you'll see some divergence there. I don't need to look at those indicators. I can see that's already going to be happening without looking at the indicators, but you can see we're running out of gas. That's all those indicators tell you, really, that the move in one direction or the other is running out of steam. And you can see we're sort of just about potentially topping with this intervention candle, where the Bank of Japan intervened, and we got a drop from 145, 146 down to all the way down to 140. That was a 600 pip drop in just a number of hours or even minutes, the majority of that move. But so that's formed a spike high, but also a spike low. And in actual fact, if anything, we've got a sort of an ascending triangle. So it is kind of bullish, although the upward momentum is running out. So that's the dollar yen. We'll be looking for long positions on there. Euro yen, well, this one's at a turning point, with the weakness in the euro counteracting the strength in the dollar yen. We've kind of been moving sideways for a number of months on this currency. At the moment, we're still below the 20-day moving average, but only just. And we'll be looking for short positions until we have a daily close above that moving average. So gold, same thing. We're below the 20-period moving average on the gold day chart. So we'll be looking for shorts on gold. And you'll see I've chosen sort of a basket of different instruments to trade, because they're all, although they are interrelated, they're all slightly different. And I can mitigate my risk by trading a basket of different things. And they're not all dollar related, although, well, most of them are. So we've got the euro against the dollar, the pound against the dollar against the Japanese yen. But then we've got a cross here, the euro yen, which has got the dollar part of the pair eliminated. So it's a dollar neutral sort of cross. And then we've got gold, which behaves a bit differently to currencies. And then we've got NASDAQ. And the same thing with NASDAQ. We'll be looking to trade this short as long as we're below the 20-day moving average on the NASDAQ, and long as long as we're above it. And at the moment, we're well below it, and having just broken down to a new yearly low, and the low of this last bearish market, a new low in this bear market. And you can see we're at critical support going back here. So it'll be interesting to see what happens with NASDAQ over the next week or two. So, and maybe a month or two. So having said all that, we then go across. So we've got our direction. So it's short euro dollar, short pound dollar, long dollar yen, euro yen still short, but it might change. Gold we're short, NASDAQ we're short. So basically everything's short except for the dollar, which is very, very long at the moment. And then we go across to the hourly charts. And again, I've got a 20-period moving average on the hourly charts. I've got it in green this time. I've also got an Ichimoku cloud, which I kind of like. And I use that in conjunction sometimes if there's any hesitation or deliberation required. And basically what I'm looking to do is to trade short or long depending on the direction of the day chart. So the day chart for all of these is short, except for the dollar yen, which is long. So, and it's really as simple as this. As long as we're below or crossing below or spiking up and down, back down through that 20-hour moving average, I'm looking to trade short. So here we go. We're looking for a short position potentially, having gone up through that 20-hour moving average on the euro dollar. Same thing with the pound, potential shorts coming up. Dollar yen, well, we've already gone long. I went long on Friday on that one. Euro yen, the day chart is still short, so we're looking to have a break beneath this 20-hour moving average to trade. And basically what I do is I trade on an hourly close. It's very important to wait for the hourly close and not just for movements up and down through the moving average. Wait for the hour to close and then trade on the top of the hour with a stop loss above the swing highs or lows. So, for example, if I was trading this euro yen short, let's just use this as an example. This is not an in-depth explanation of how I trade because I do take into consideration other things like chart levels, Fibonacci levels, and even the Ichimoku cloud, which can be useful if we're in the region of that cloud. As you can see, from time to time, it does act as support or resistance, and it's quite an interesting little indicator that many people don't use or understand, and you'll see it often. Let's just have a look at this one, for example. It often acts as a useful indicator for trend direction, and also the cloud itself often acts as support or resistance, depending on which direction we're trading. Now, so we want to. So, for example, if we were trading short on the euro here on a close beneath this 20-hour moving average, we'd want our stop loss quite tight above this swing high or above this swing high there and there. So we'd want to put our stop loss about there at about, in this case, 98.26 or 25 or 30, or above there. If you're going to use a stop loss bigger than 30 or 40 pips, then reduce your position size. I never trade with a position size which will give me a loss of more than 1% on any given trade. So I use that as a guide, a 1% stop loss essentially, which is 100 pips when you're trading unleveraged 1-to-1, or it's 50 pips if you're trading 2-to-1, or it's 30 pips if you're trading 3-to-1 leverage, or it could be 200 pips if you're trading at half-to-1 leverage. But I think 1-to-1 or 2-to-1 leverage makes the most sense in these sorts of markets. You can get away with a 1% risk with a decent sized stop loss, and you're away. So, and often these trades won't all trigger simultaneously. You'll maybe get the pound giving you a signal and gold at the same time, or the euro and the euro yen, or the euro and NASDAQ, or dollar yen and euro yen, whatever it might be. Try not to be in more than 2, perhaps 3 currencies at the same time, and definitely not if they're all the same, sort of like against the dollar. So like the euro, the pound, and the dollar yen. And you can also trade other currency pairs if you want to, like the Australian dollar, New Zealand dollar. You could trade the Canadian dollar against some of these other instruments, the euro and the pound, whatever you choose and whatever you're comfortable with, and also particularly what you're used to, because all currencies have a sort of personality and trade differently. So we've had a very tough week. I lost quite a lot of money on my challenge account. That's okay. I expect that to happen from time to time because it is a fairly highly leveraged account. I didn't lose very much money at all on my main account, which is great. I did survive. I had my positions closed before that dramatic drop on the pound. If I'd held my positions on the challenge account during that drop, I would have had a margin call, and that would have been the end of that challenge account. As it is, I've got to start building back up that little bit of a loss that I experienced, and that's going to basically have been set back by a month or a month and a half. But that's okay. That's trading for you, and I avoided the worst of it. So I hope you found that useful. So just use the 20-period simple moving average on the day chart for direction. Use it for a trigger on your hourly chart. And you can also throw in some other things like, as I've got here, the Ichimoku cloud. You could put in a trend line. Look for candle reversal patterns, spike highs and lows, engulfing candles, hanging men type candles, all that sort of thing, the usual trading tools that you might use in any other system. But be careful to go with your daily direction. It's really, really important because as you saw on the pound, we dropped 3% or so in seconds on around last weekend. I was watching it at 2 o'clock in the morning, my time, in absolute horror and fascination and a morbid curiosity and a bit of a feeling of pity for people that were in the market and that lost a great deal of money, and I do know some of them. So take care, have a great week. I've got some interesting news for you, by the way. I've switched brokers. I've been looking around at different brokers. I've tried a whole bunch recently. I've found a lovely, amazing broker, which I'm really happy with. I'm going to tell you about it in my next video. So keep your eyes tuned for that. But if you'd like to go and have a look at what I've got, there's a link underneath this video. There's a link on the main YouTube page. And if you go to my website, ArcisFX, that's ArcisFX.com, you can have a look at the details of the broker there. Very low spreads, fantastic execution, wonderful crowd of people to deal with, and I think you'll find that really interesting. And I'm going to do a review on the various brokers that I've traded with recently, including Oanda, including Vantage, and this new one, which is Black Bull Markets. And I think you'll enjoy that video, particularly for those of you who are looking for a reliable and low spread and well-regulated broker, solid, decent platform to trade with. Take care. I'll speak to you along the way as we go along.